Chapter 1, Test Review, questions 16 through 18. Based on the following, what things change owner's equity? There's only four things that change owner's equity. Investment increases owner's equity. Revenue or income, I prefer to call it revenue, also changes owner's equity, increases it. Expenses or losses reduce owner's equity, and withdrawals by the owner also reduce owner's equity. So let's look at these things we've got here for 16 through 18. If assets were $25 and liabilities were $15 at the beginning of the year, so let's do that. Assets are $25 and liabilities are $15. Then you can automatically compute owner's equity, which that little C stands for, compute, which means owner's equity would be the difference, which is 10. And that's at the beginning of the year. Assets were $40 and liabilities were $10 at the end of the year. So let's do that. We're looking for net income now, right? And so let's just add these things up here. We've got at the end of the year assets were $40, liabilities were $10, so therefore you know automatically that owner's equity is $30. Now, here's what's important to remember. If assets and liabilities at the beginning of the year equals owner's equity, and owner's equity is 10, and we know that owner's equity at the beginning of the year is 10, and owner's equity at the end of the year is 30, then owner's equity changed, or it went up by $20. So the question is, what made it go up? And now there's only four things altogether that can change it, right? And you know, if you didn't have any investment by the owner and you had no withdrawals by the owner, then what you know is that the entire change, or all of this $20 difference, is made up of one thing: net income. And so therefore, what is net income if the owner made no investments or withdrawals during the year? Well, the net income, since it did change plus 20, had to be $20. I could say this another way. I could say, well, what happened if owner's equity was 30 at the beginning, and that's 10 at the end of the year, and you had no investments and no withdrawals? Well, if it started out at 30 and ended up at 10, that means it went down 20. So therefore, this entire difference must have been net a loss, or they had a loss. Okay, that's 16. Number 17, we got the same exact facts, everything's the same, except we're going to add one more thing into this equation, which is the owner had a $5 investment during the year, but still no withdrawals. So let's look at all this. Now, again, assets started out at 25 and liabilities started out at 15. Therefore, owner's equity is 10. Assets ended up at 40. Liabilities are 10, and therefore owner's equity at the end of the year was 30. So we still have a $20 difference. In this case, it's a $20 increase. Now the question is, how much of this $20 increase came from income? Well, if you know that there is $5 already included in this change based on the owner's investment, then there's only $15 left to account for, and that $15 left to account for would be how much of this change was due to income, or in this case net income. Okay, so it's $15 net income. Now let's look at number 18. Number 18 is a little more difficult, but it's the same basic idea. They want to know, let's see, a company reported total equity of $145,000 on its December 31st, 2003 balance sheet. The following information is available for the year ended December 31st, 2004. So we're just going 1 year later. And we know that revenues during 2004 were $210,000, expenses were $165,000, and liabilities at the end of 2004 were $92,000. What are the total assets of the company at December 31st, 2004? So let's make up our little accounting equation with a timeline on it here. There's assets equals liabilities plus owner's equity. The beginning balance of owner's equity was $145,000, and that was at the end of 2003. And now during 2004, we're going to add to this owner's equity. We're going to add revenues of 210. We're going to subtract expenses of 165, and we're going to get ending owner's equity. If you take 145 plus 210 minus 165, you get the ending owner's equity at 2004 of $190,000. So if the ending owner's equity is 190 and the ending liabilities are 92,000, like it says right here, what are the ending assets? Well, the ending assets would be the sum of these two, which would be 282.